On the move this morning after the company formally opened acquisition negotiations with Apollo and Sony. That's according to the latest report here from the New York Times. We're looking at Paramount shares up just about 3%. Now, this news coming after its exclusivity period with Skydance ended over the weekend. Robert Fishman is MoffettNathanson's managing director and equity research analyst joining us now. It's great to see you. So talk to me just about your view on this Apollo-Sony bid and what is the more attractive potential outcome here for shareholders?
Well, it's interesting that you say for shareholders. We have to define which shareholders we're talking about here.
That's a very good point.
So for independent shareholders, based on all the press reports, I think it's pretty clear that the Sony and Apollo bid is the best possible outcome. But of course, there's still lots of uncertainty here, and there's still a controlling shareholder in terms of which direction that she's going to choose to go.
So what do you think the path forward then looks like from here?
I mean, really, day by day, it continues to swing. Clearly, what we've just, as you mentioned, exited the exclusive window with Skydance, and now that opens up other potential possibilities. The company is also proceeding as if there's a potential for no deal to happen. So there's lots of uncertainty that comes to play with all these different scenarios, and there's some risks involved in that too. So as an independent shareholder, really you've been swung around and trying to understand how the future of this can go, because as an independent company going forward, there are still significant challenges ahead, and that includes fundamental challenges on the business that we follow.
Well, our own Brian Sozzi spoke with the CEO of Apollo earlier about the potential deal. Here's what he had to say.
We are a purchase price matters, value-oriented firm, and the way value is created today is usually in places that are undergoing substantial change. So media as an industry, I don't have to tell you, sitting in Yahoo, that media is undergoing substantial change. The notion that you could come in and build on a great business and try to navigate through these turbulent times, I think is where we create value. We historically have been long investors in media. We've done it across almost every sector in media. Obviously right now we are invested in Yahoo. We are also invested in Legendary. And by bringing along a respected industry partner, Sony, I think we look at this as just an interesting opportunity to create value in an industry undergoing change.
And as he mentioned there, I should say that Apollo is the parent company of Yahoo, but I want to get your take on that. It sounds like he's sort of touting the benefits of working with a PE firm in this deal, but I wonder to what extent folks should be thinking about the potential drawbacks, particularly given the regulatory environment that we're in right now.
Yeah, I mean, clearly we're in a more heightened regulatory environment, and that would put at least some of the potential upside of a deal more at risk, given the uncertainty that comes with that, and the current administration, and how they look at these types of deals. But as far as some of the value that can be extracted from a deal, clearly combining two studios would extract some synergy value there. So understanding that, but also it comes down to what are they going to do with the linear assets? And there are some better linear assets and some significantly challenged ones as part of the cable network portfolio that the Viacom holds.
I want to bring up some of the comments that we heard. I was out at Berkshire this weekend, and Warren Buffett weighed in on Paramount, saying that the company exited the stake that they have had in Paramount, talking about the amount of money that Berkshire has lost on that investment. But what was interesting here in those comments, to me at least, was what Buffett had to say just about the fact that how everything has played out has caused him to think a little bit more deeply about how people spend their leisure time. And we know he's talked about in the past the need here, or the likelihood that we will see some consolidation within this space. I'm curious how you're evaluating the potential winners within this space, and how many of these acquisitions you think are likely going to take place going forward until we get some more certain leadership within the streaming sector.
Yeah, it's a great question. Thank you. So I think as far as how we think about this, we've been talking about since really a couple of years already, that the streaming business is really not a great business, and especially when you compare it to how good the old business was in terms of the pay TV ecosystem, and how that you got paid regardless of engagement and regardless of churn and all of the issues that come into play with streaming. It's a much more difficult business to be competing against, and especially given the lead that Netflix has and how they've essentially already won the game. So where you go from here is there needs to be consolidation. We've been talking about that for a couple of years as well. And you need to have more rational players at hand so that they can get better economics out of the streaming ecosystem. But that's not to say it's going to be as easy to match the success and the profit levels that were generated in the old ecosystem.
Well, I'm curious then, you talk about kind of the need for consolidation and some, it sounds like basically more adulting in the room. What would that look like? What would success in that effort look like to you?
I mean, success means that you need to at least partner with other streaming platforms and not be competing against them, especially for the subscale players. So that will require different partnerships or combinations that come into play there. And then really from there, you need to also stop accelerating the demise of the pay TV ecosystem by leaking all of the premium content over the top and allowing consumers to watch all of the must-have content, primarily sports, in the over-the-top world at a discounted price to what they're charging to the wholesale players. And that leads us to the ongoing negotiation that Paramount is having with Charter right now.
So let's talk about what we're going to hear about the space from Disney tomorrow. They're set to report earnings before the bell. A number of key things that will be watched from the street when you talk about the impact on the parks business, what the health of that business looks like, when you talk about the summer box office, exactly what they're seeing there. But the big focus is really going to be on the streaming business and what exactly demand looks like within that space. I'm curious, what are you expecting to hear from Disney, and how big of a factor do you think that's going to be on some of these other larger streaming giants here going forward?
Yeah, I mean, we've been talking about for Disney that streaming is obviously the future, and it's partly the future of their company too. And so what do I mean by that? What we are looking for is a better strategy long-term in terms of how all of their different streaming platforms can come together to help them be that strong number 2 global player in streaming and compete with Netflix, given the assets that they have, and not compete on a pure content for content basis, because Netflix clearly has a different approach in terms of just the sheer volume that they bring to the table on streaming. But given the assets with sports and with Hulu and with Disney Plus, most importantly, and the library that they have on the Disney side, we think that Disney has all of the assets that can compete on a global scale basis.
All right, Robert, we're going to have to leave it there, but really appreciate you joining us. That was Robert Fishman, MoffettNathanson Managing Director and Equity Research Analyst.